Okay, in this lecture, I'm going to talk about the major categories of intangibles. I am not quite sure why this is so helpful, but it is a kind of a standard thing that's done in the textbook, but across really um, the codification and all education about it. So it is a way to think about the different types of intangibles. So, in your education for every transaction, accounting for every transaction, you have to learn the transaction itself and then the accounting for the transaction. So to the extent that this helps you learn more about intangibles that you are likely not familiar with, I guess it's a good thing. So here are the major categories. Um, I am not going to explicitly test you on these, FYI. What you will need to know, and I'll discuss as we go along, is how, not by category, but by really, I'll tell you the two types that I think, or the three types I think matter, are limited life, indefinite life, because these are the accounting classifications. And then goodwill. Goodwill has an indefinite life, but it also has its own accounting. All right. So these are accounting classifications. So what you need to know is, oh, it's this type of intangible. That type of intangible is a limited life. Oh, it's this other kind of intangible. That type of intangible has an indefinite life, or it's goodwill. Okay. So here are the categories: marketing related, customer related, artistic, contract, technology, and then goodwill. This is created by accountants. So really, people will talk about goodwill, but this is really something that was created for the purpose of uh, creating financial statements. All right, marketing related. So um, trademarks or trade names. Coca-Cola is a trademark that has an indefinite life. Internet domain names, very valuable. I mean, you could imagine if you had the domain name for like hotels.com or banks.com, just general names, they have value. Internet domain names can be re-upped every few years, 3 years or something, for a trivial amount. So that means they have an indefinite life. Um, Non-competition agreements, those are controversial, but anyhow, so trademark in particular, we'll see that a lot, has legal protection for a definite number of years and a 10-year renewal period, but it's a trivial amount. And since it's a trivial amount, it has an indefinite life. Okay. So, you know, you can know it's a marketing related intangible, but the main thing is, that a trademark has an indefinite life. Okay. Um, just in terms of thinking what has value, though, uh, I don't think it would be difficult for any of you to imagine that if you somehow got control of the Coca-Cola trademark, like the guy at Coca-Cola or the woman at Coca-Cola, forgot to re-up, renew the trademark, and you somehow found that out and took the trade name, that would be worth quite a bit of money. And if you were that person, you'd hate to be that person too. But anyway, you get the idea. Customer related intangibles, customer lists. So a lot of the tech companies, they get information. So it's not a customer list per se, but they get information, a lot of data um, from users of their systems. And some companies, they even gone bankrupt, they still are able to sell their list for millions sometimes, or all their list with all the data. So that's a customer related intangible. That's more, I guess, current. Back in the olden days when they had customer lists and you made phone calls, those were very, very valuable. Um, and they still have those, but maybe not as common as um, tech companies using big data and selling big data. Um, so that's customer related intangibles. Those are a limited life because, people move, people get older, so on and so forth. So they have a limited life. Artistic related intangibles, and this is one that people commonly think of as a copyright. So, movie scripts, books, music, all that kind of stuff. Any article you may write, it's automatically copyrighted. The copyright is granted for your life plus 70 years. So that's quite a long time, but it is limited. I mean, you could estimate how long somebody will live and then add 70 to it. So it does technically have a limited life. A really great example of this is, I don't know if anybody knows who David Bowie is anymore, but David Bowie, this is how you could see a right at work. He took all his copyrights, took his copyrights and he signed it over to a trust, and then investors. So if you make this, here, I'll go over here. It had copyrights, and then investors bought shares. So the investors put dollars over here, and then David Bowie took dollars out. So he was going through a rough patch financially, and Wall Street bankers said, hey, you could sell your copyrights because all the royalties generate cash flow, put it in a trust, and we'll give you the cash from the shares. So that's a way to what's called monetize or generate cash out of an intangible asset, is to put it in trust. And you may have heard a lot of companies, what they do is they put their property rights, intellectual property rights, in Grand Cayman or other places that are remote from U.S. taxation. You know, um, I'm not I'm not giving an opinion on that. I'm just saying that it's these rights can be moved around and put in certain structures where clearly the value is, it's transferable and it's easy to see the cash flow generated by them, which is why they're assets, even though they don't have physical form. Contract related franchises and other licensing agreements, broadcast rights. Your cell tower bandwidth is auctioned from the federal government. Very, very valuable. Um, Franchises are interesting because they can have a limited life or an indefinite life. It's by contract. If it doesn't tell you, assume an indefinite life. But typically the problem will tell you whether the franchise is limited. So a limited franchise would be, we have this product and we're going to let your store sell it in Madison County for the next 10 years. And after that, we'll reassess. So that would be a limited life. An indefinite life is like the baseball Cardinals. You may hear Cardinal or baseball teams referred to as a franchise, like the Cardinals franchise. And it is a franchise. Major League Baseball sets the rules, and they have to operate by those rules, but they own the team indefinitely. So they all operate by the same rules. Like the Cardinals can't say when you come to Busch Stadium, you get 2 strikes and we get 3 strikes or something like that. So there is a headquarter Major League Baseball. So you have Major League Baseball and then franchise, just a bunch of, these are all franchises. McDonald's, you may have heard, is also a franchise, has a corporate headquarter, but each McDonald's is owned by a company or an individual. Then they have to pay a percentage of revenue back to McDonald's, and they have to operate according to McDonald's. They can't decide we're going to use this kind of meat or create some new sandwich or that type of thing. Okay, but you get the idea. These broadcasting rights, licensing agreements, things like that, they may be limited or indefinite life, but the big one we'll see out of this contract-related intangible is franchise. And again, if it doesn't tell you, assume indefinite life, but it will likely tell you. Technology related, the patent, we're going to see patents. So this has a legal protection, as does the copyright. So that's kind of interesting. Whenever it has legal protection, it's easier to transfer. If it doesn't have legal protection, it's not impossible to transfer, but it gets a little more tricky. So it gives in the U.S. patent gives the holder exclusive use of a period for 20 years. I don't want to get too much into the legal aspect, but there are treaties and so forth that recognize rights patent rights. So this is a limited life intangible. All right. So that's the important thing to know about a patent. So, you know, if you're a drug company, you're going to have a patent because you have to disclose everything when it goes through FDA process. So it's going to be publicly known. However, I do want to show a case of when it may be worthwhile not to do that. If you're a little squeamish, you may want to skip this part of the lecture. There, in the evolution of jet flight, and you know, for those of you who know me, I mean, I'm sure you're shocked that I like watch engineering shows and whatnot. But one of the things that had to happen was they had to develop a glass that could take a bird strike. Because, you know, when a jet's going 500 miles an hour and it hits a bird, goes through the window and hits the pilot, that's not really like a great situation to be in. So one of the necessary components is to have glass that will protect the aircraft and the pilot. So a company developed the glass, and they decided not to patent it, but I'll talk about that in a second. But what they do to test it is they take a bird, not a live bird, like a defrosted bird that was, you know, in the grocery store or something, and they shoot it out of an air cannon against the glass, and this is what happens. Okay, let's see that again. There is absolutely, you can't even see the bird, and the glass is not harmed at all. Now you would think, why, first of all, you'd probably think, why in the heck is he showing us this? Well, it's a great example of management strategy in relation to a patent. That company decided not to patent their process, because if they were going to patent it, they'd have to reveal their secret. And instead, what they've done is worked very, very hard to protect the secret process for that glass, because that process is not patented. They can't transfer it to another company. So the only way it's revealed is through excess net income. The value of it's revealed, I should say, is through excess net income. So it's kind of an interesting example of not getting a patent because you'd be limited to 20 years. So that's a management strategic decision, but as an accountant, what that would mean is you can't recognize any patent anywhere, and you couldn't sell a patent. You couldn't sell the patent, and if the company gets bought out, you can't value the patent because there is none. So it's just a really interesting example of where clearly they've created a product with a lot of value, but because it's not separately identified, it's problematic to account for it. Whereas if the same company had a patent, then you'd be able to identify the patent and value the patent. Okay, so I just tried to show that bird thing as an example of how management makes a decision for an intangible and it will impact the accounting. Even though you could have two companies in economically identical situations and with the same product, but one patents and one doesn't. Okay, all right, goodwill. We're going to have a lot of discussions about goodwill, and we're not going to explain it all right here, but just generally, this is something that the accountant creates, and it only is created when one company buys another, and it is technically the difference between the market value of a whole company and its liquidation or net asset value. So you take fair value of assets less the fair value of liabilities. That's a number, and then the price is always greater than that, and the difference between those two is the is goodwill. So it's the purchase price above or over the fair market value of the identifiable net assets created or acquired. Internally created goodwill will not be capitalized, and we'll talk more about that later. Okay, but those are the 6 major categories of intangibles. Once again, the main takeaway is starting to learn limited life, which ones are limited life, indefinite life, and then a little bit about goodwill.